Investors, silver just broke through a level it hasn't touched in over 40 years. And the analyst who called gold's move to $3,500 months before it happened is now pointing at numbers that will sound absolutely impossible until you see the data behind them. What Gary Wagner has just laid out is not a prediction. It's a technical and fundamental roadmap. And if he's right, even partially right, what you do in the next few weeks could define your financial position for the next decade. Welcome back. If you're new here, this channel covers precious metals markets with the seriousness they deserve. No hype, no noise, just data, analysis, and the kind of market intelligence the major financial press buries in footnotes. Today we're breaking down Gary Wagner's latest technical outlook, one of the most respected voices in gold and silver charting, and combining it with what's happening right now at the COMEX, in central bank vaults, and across the geopolitical landscape. Because right now, gold and silver are not moving on speculation alone. There are structural forces at work, and if you don't understand them, you're flying blind. Stay with us through this entire video. The scenario analysis at the end is critical. Let's establish the baseline first. Gold has been one of the most powerful trades of the last 18 months. From its breakout above $2,100, a level that had acted as resistance for years, the metal has now surged past $3,400. At the time of this recording, gold is trading at levels that 2 years ago, mainstream financial media was calling unreachable. They were wrong, badly wrong. Now silver. This is the story that's not getting nearly enough attention. Silver has followed gold's lead, but with the kind of leverage that silver investors have always understood. When gold moves, silver can move faster and further. Gary Wagner's technical work identifies $80 as not just a psychological level, but a major structural pivot, a zone that, once broken and held, opens a path to targets that extend well beyond $100. But here's what almost nobody's telling you. The move in silver isn't just technical. The fundamentals behind it are arguably more bullish today than at any point in the last half-century. Animate COMEX open interest data show registered versus eligible silver inventories graphic. Use red arrows to show declining registered stock. Let's talk about the COMEX, because what's happening there right now is extraordinary. For years, critics of the precious metals paper market have argued that gold and silver prices were suppressed by an oversized futures market, where paper contracts representing metal far outnumbered the physical metal available for delivery. That system is showing serious cracks. COMEX registered silver inventories, meaning silver actually available for delivery, have been in a structural decline. Meanwhile, demand for physical delivery has been rising. Industrial users, primarily in solar panel manufacturing, electric vehicles, and electronics, are pulling physical silver out of the system at a rate that is outpacing new mine supply. The Silver Institute's most recent data confirms a multi-year supply deficit. We are not talking about a temporary blip. The structural deficit in the physical silver market has now persisted for 4 consecutive years. Now pay attention, because this changes everything. When physical demand structurally exceeds supply, and at the same time investment demand surges, which is exactly what is happening as European and global investors seek inflation hedges, the paper price eventually has to converge with physical reality. Wagner's chart work is essentially tracking that convergence in real time. Now let's pull back and look at the macro picture. Because technical levels don't exist in a vacuum. They exist within a fundamental environment. And that environment is as bullish for precious metals as anything we've seen since the 1970s. The euro has been under persistent pressure. The ECB has been caught in an impossible position. Angst, inflation that refuses to fully retreat, growth that disappoints, and a political landscape across member states that makes coordinated fiscal discipline nearly impossible. When a currency loses credibility, real assets gain it. Meanwhile, the U.S. Federal Reserve is sitting on a powder keg. The U.S. national debt has crossed $36 trillion. Interest payments on that debt now exceed defense spending. Every interest rate decision the Fed makes is now partly a debt management decision, not just an inflation management decision. This is what the big banks don't want you to know, or more precisely, what they don't want to talk about loudly in their public-facing research. Every major central bank in the world is now structurally incentivized to allow inflation to run slightly hot, because inflation, quietly, slowly, erodes the real value of sovereign debt. And that is exactly the environment in which gold and silver have historically outperformed every other asset class. BRICS nations, meanwhile, continue to accumulate gold reserves at a record pace. China's People's Bank of Gold has been a consistent buyer. Russia, India, Turkey, all adding. This is not speculation. These are publicly filed reserve figures. The Western financial press treats this as a footnote. It is not a footnote. It is a tectonic shift in how the global monetary system is being restructured beneath our feet. Now, let's get into the technical framework that Gary Wagner has been laying out. because this is where the rubber meets the road. On gold, Wagner's analysis centers on Fibonacci extensions from the 2018 low to the 2020 high projected forward. The $3,500 level represented the first major extension target, now achieved and, critically, held as support on pullbacks. The next Fibonacci cluster sits in the $4,200 to $4,400 range. Beyond that, and this is where his most aggressive projections live, the $6,000 level emerges from the longer-term weekly Fibonacci structure, mapped from the 2015 cycle low. Is $6,000 gold guaranteed? No. But here's the important technical principle: markets that break major Fibonacci targets and hold them have a statistically elevated probability of continuing to the next cluster. Gold has done exactly that, level by level, pullback by pullback. For silver, the technical picture is equally compelling. The $80 level represents a convergence point, a horizontal resistance zone that dates back to the 1980 spike high, adjusted for modern price structure, combined with a long-term Fibonacci projection from the 2001 bottom. Breaking and holding $80 on a weekly closing basis in Wagner's framework would constitute a technical confirmation that opens the $100 to $120 range as a realistic medium-term objective. And further extension targets, using Elliott wave overlays that Wagner has applied, point us toward the $140 to $160 zone over a multi-year horizon. These numbers sound extraordinary. They are extraordinary. But so was $3,400 gold 18 months ago. Let's run the scenarios, because no analyst, including Wagner, operates with certainty. What we can do is assign probabilities and prepare accordingly. Scenario 1, the bull case. Gold breaks cleanly above $3,600 resistance on strong weekly volume. Silver consolidates above $80 and confirms the breakout on the next monthly close. Central bank buying accelerates, the Fed signals a more accommodative posture, and dollar weakness extends into the second half of the year. In this scenario, gold tracks toward the $4,200 to $4,400 Fibonacci cluster within 6 to 12 months. Silver pushes toward $100 and potentially beyond as retail and institutional investment demand floods into an already physically tight market. This is the scenario Wagner's primary technical read currently supports. Probability assessment? Elevated, though not certain. Scenario 2, the base case. Gold consolidates in a wide range between $3,200 and $3,800, digesting its rapid advance. Silver holds above $70, confirming the structural breakout, but moves more slowly, grinding higher, through the second half of the year. In this scenario, $6,000 gold and $120 silver remain targets, but on a longer timeline of 2 to 3 years rather than 12 months. This is still an enormously positive outcome for investors who are positioned today. Scenario 3. The bear case, a sudden reversal in macro conditions, a surprise hawkish move from the Fed, a rapid de-escalation of geopolitical tensions, or a sharp risk-off event causing forced selling across commodities, pushes gold back toward the $2,800 to $3,000 support zone. Silver, which tends to be more volatile, could retrace toward the $60 to $65 range in this scenario. This is the scenario that argues for disciplined position sizing rather than concentrated bets. And it is worth noting, even in this bear case, the structural thesis for gold and silver remains intact. A pullback to $2,800 in the current fundamental environment would historically represent a buying opportunity, not a reason to abandon the thesis. Let's bring this together. Gary Wagner's technical framework, combined with the fundamental picture we've examined today, tells a coherent and urgent story. Physical silver markets are in structural deficit. Central banks are buying gold at near record pace. The ECB and the Fed are both operating under conditions that historically favor real assets over paper currency. The COMEX paper structure is showing signs of stress, and the technical levels that Wagner has identified, $80 silver, $6,000 gold, are grounded in decades of Fibonacci and Elliott wave methodology, not wishful thinking. The scenarios we've laid out range from explosive upside to a temporary pullback, but in every scenario, the medium to long-term direction for precious metals remains firmly higher. What you do with this information is, of course, your decision. But history is quite clear about what happens to people who hold hard assets through periods of currency debasement and monetary instability, and what happens to those who don't. If this analysis was valuable to you, and if you want to stay ahead of the next major move in gold and silver, hit that subscribe button right now and turn on notifications. We publish deep dive analysis like this regularly, and you cannot afford to miss what's coming next. Drop the word gold in the comments if you're bullish on gold right now. Drop silver if you think silver is the bigger opportunity in the months ahead. We read every comment, and your responses directly shape what we cover next. And if you want to go deeper, our full breakdown of the COMEX physical delivery crisis and what it means for silver prices specifically is coming in our next video. Stay positioned, stay informed. We'll see you in the next one.